Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 178 of our YouTube channel and podcast, and I cannot be more excited to continue sharing with you guys personal finance topics that I think can be useful for you in your long-term financial journey. Today, we are going to be talking about recessions. And the reason that we're talking about recessions is because this is Financial Literacy Month. I'm dedicating this week to a bunch of different financial literacy type topics. We have talked about already this week bull markets and bear markets. We've talked about compound interest and the rule of 72 and how your money grows in yesterday's episode. And today we are going to be talking about recessions. Now, I think it's really important to talk about recessions because people really don't know what they are, even though one, we have been in the midst of one very recently. Two, we have had some in the past, and people just use the word recession as some buzzword, and it's scary, and for good reason it can be scary, but I want to put you more at ease about the idea of recessions and really help you to understand what they are, how they work, and what they have looked like in our past as a country. So tune in for that and much more in today's episode. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcast, then be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to create a financial plan that is specific to your life and can help you to stay accountable to a financial plan over the long term, then I can do that. Just go to my website, www.mnowithdylan.com. Click on the Work with Dylan tab, and you can choose the financial coaching session type that would work best for you, and we can begin pushing towards your long-term financial goals together. So let's just start right off the bat. What is a recession? Well, a recession is a macroeconomic term, meaning it is a term that is about the larger economy, not specific small things that may be occurring, but the economy as a whole. It's a macroeconomic term that refers to a significant decline in general economic activity in a designated region. In this case, we are talking about United States recessions. We're talking about our country having recessions. It has typically been recognized as 2 consecutive quarters of economic decline as reflected by GDP in conjunction with monthly indicators such as rises in unemployment. So what does that mean, right? There might have been a few things there that kind of got you off track. So it has typically been seen as 2 consecutive quarters. So 2 consecutive quarters would be like from January to the beginning of July, right? 2 quarters of a year, or maybe, it rolls into another year, but at least 2 consecutive quarters, right, of economic decline as reflected by GDP. Well, what is GDP? GDP is gross domestic product. Now, this is the sum of all the goods and services that are produced or rendered within the United States in a given year, right? So the GDP is our major measure, albeit maybe not the best measure, but it is the most widely accepted measure of economic productivity that there is. And we look at whether or not GDP has grown over these quarters, right? Every quarter, it's very important. You watch CNBC, you watch any other business news channel, they are always interested in what the Federal Reserve has to say about GDP growth. We're really interested in what GDP growth is and how it compares to quarters past for us, how it compares to years past for us, how it compares to other countries that we are actively competing with. And so 2 consecutive quarters of negative GDP growth would be what we're talking about here with the recession definition that we're going to work by. And so this means for 2 consecutive quarters, your economy got smaller in terms of the amount of goods and services that were produced or rendered within that economy. So the National Bureau of Economic Research, which officially declares recessions, says that 2 consecutive quarters of decline in real GDP are not how a recession should be defined anymore. And that is widely agreed upon. The NBER, the National Bureau of Economic Research, defines a recession as a significant decline in economic activity spread across the economy lasting more than a few months, normally visible in real GDP, real income, employment, industrial production, and wholesale retail sales. And so they make it a more all-inclusive definition And they make it not just a hard and fast rule of negative GDP growth, which is still likely going to coincide with their definition of what a recession is, but it's not just holding it to that specific standard. And so we see these are what recessions are. These are contractions in our economy. You're either expanding or you are contracting, and recessions are these contractions in our overall economy. Now, recessions work alongside expansion, and obviously expansions are a lot longer in time period because growth continues a lot longer than the recession of a specific country, specifically ours, which has been a world power for a long time, does. But if you look at expansions and you say, okay, how long do expansions last? Because you see, in order to call something a recession, we're talking, more than a few months, a couple of quarters, something that may last a year, maybe more, but that would be a long recession, right? But if you have one of these recessions, they're followed typically by expansions. And the longest expansion is actually one that we just got done with, right? The expansion from June of 2009 all the way until February of 2020, right? This was a 128-month expansion, which is the longest economic expansion we've had in the United States in the last century. And it was only brought down by something that was not, even part of the system in the first place. It was external. It was an exogenous event. COVID-19 was an exogenous event that brought down that economy into a recession, which this is one reason why I think it's important to talk about what recessions are today, because a recession has been something that we have been dealing with when it has come to, high unemployment, the economy contracting because of COVID-19 and things of the like. And so recessions are really important to understand in that way. So let's understand them a little better. So since the Industrial Revolution, the long-term macroeconomic trend in most countries has been economic growth. Obviously, because that Industrial Revolution brought a lot of new machinery, a lot of new tools, a lot of new jobs, a lot of new things that people could do in order to increase economic growth over time. Okay. Along with this long-term growth, however, there have been short-term fluctuations when major economic indicators have shown slowdowns or even outright declining performance over time frames of 6 months up to several years. Before returning to their long-term growth trend, these short-term declines are known as recessions. Okay, so these short-term fluctuations, these short-term downward corrections of economies, or these recessionary times, they are relatively common. They do occur, and they do occur more often than we would like to think. Yes, we have seen two, let's say in the last 12 years or so, that have been quite major and quite significant. And the reason that the past two have been quite major, quite significant is because obviously there was the Great Recession, which was, the 07 through 09 recession. And that was something that was, bigger than any recession we had seen since the Great Depression. But obviously we saw the COVID-19 pandemic hit, which is extremely significant, which caused a recession as well. And so we have this big, scary boogeyman thought about recessions. And yes, recessions can be extremely negative, but it does not mean that they are not a normal part of our business cycles. They are a normal part of business cycles. Expansions and contractions both occur. So yes, a recession is a normal and unpleasant part of the business cycle. Recessions are characterized by a rash of business failures and often bank failures, slowdown or negative growth in production, and elevated unemployment. The economic pain caused by recessions, though temporary, can have major effects that alter an economy. Many people think that the recession that was caused by COVID-19 is going to have a long-term impact on our economy, how we do business, and the businesses that actually stay open over the long term. And it's going to accelerate the path of certain businesses downward and accelerate the path of certain businesses upward. We've seen that things happening online and purchasing things online, having your groceries delivered, having your food delivered, has just skyrocketed in the past year or so. But we've also seen that the cruise line industry has taken a major hit. Airlines have taken major hits. You've seen that people don't go to brick and mortar retailers in the same way that they have historically. You've seen that a lot of small businesses have gone out of business because of the COVID-19 pandemic. And so we see that recessions have a real impact. Recessions do have a real impact on the economy, but they do differ in their magnitude. Okay, so structural shifts in the economy can occur, right? And these structural shifts may come as vulnerable or obsolete firms, industries, or technologies fail and are swept away. Dramatic policy responses by government and monetary authorities can occur as well. And so we typically look to the Federal Reserve. The Federal Reserve being the central bank of the United States, and the Federal Reserve being the governing body that does set our monetary policy. They do look at interest rates and the rate at which businesses can borrow from banks, or that banks can borrow from one another, and they set those baseline rates, right? They do put things into place to try to spur economic growth when there is none, or try to keep the economy from overheating as it is growing very quickly. They try to get employment to a normalized, a natural level, and not to an overly depressed level, or to a level that is far outpacing what is realistic either. So the Federal Reserve is the governing body that does that for us, and they do make dramatic responses, right? During the COVID-19 pandemic, we saw interest rates go basically to zero, and do so in a very swift fashion, right? We also saw that they purchased a lot of bonds from the market, therefore injecting more capital into the market, right? They're trying to keep money flowing during a recession. They're trying to keep economic activity happening. Obviously, Congress goes through and they pass multiple stimulus bills that provide money into the economy. Now, they do a lot of other things too, but it gives money to consumers, and has given a lot of money to businesses and these governmental organizations as well. And so we are able to see that there are governmental authorities that step in and make a lot of changes. And a lot of people don't like that because a lot of people are more free market. I see myself as more free market as well. A lot of people think, oh, we'll just let recessions run their course. Well, there are some things that you just can't allow to go untethered. You can't allow to go without some type of intervention, some type of help being involved. Because who could have foreseen a global pandemic? Who could have foreseen something so drastic and huge occurring? I surely couldn't have. I don't think you could have either. And I think the government stepping in to help a lot of businesses was warranted. But the allocation of money may not have been the most efficient thing that could have been done in hindsight. So those types of things occur. Now, for investors, one of the best strategies to have during a recession is to invest in companies with low debt, good cash flow, strong balance sheets, things of the like. Right? This isn't to say to change your investing portfolio because of recessions. This is just to say if you wanted a more recession-proof portfolio, you would have companies that are lower debt, good cash flow, and strong balance sheet, because they can weather the storm a lot better. They can get through things that are negative a lot better because they actually have cash, and they don't have drains on their cash flow when it comes to debt. And so that would be specific things that investors could do. And I'm not going to dive too deep into that, but that's just a quick corollary that I think would be quite interesting to many of you. So recession predictors and indicators, right? There are things that can predict and or indicate that a recession is coming. There's no single way to predict how it will occur. Aside from 2 consecutive quarters of GDP decline, economists assess several metrics to determine whether a recession is imminent or already taking place. And that's the weird thing about recessions, is that sometimes you are within a recession and you don't know that the recession is already taking place, or that has already begun, because the indicators, the metrics won't come in until later on. Now, according to many economists, there are some generally accepted predictors that when they occur together may point to a possible recession. First are leading indicators. So these lead the recession. They go in front of the recession. And they historically show changes in their trends and growth rates before corresponding shifts in macroeconomic trends. So these may include things like the ISM Purchasing Managers Index, the Conference Board Leading Economic Index, the OECD Composite Leading Indicator, and the Treasury Yield Curve. One that is very interesting is the Treasury Yield Curve, because the yield curve being inverted, meaning the longer maturity treasury bonds having lower rates of returns than the shorter maturity treasury bonds is typically a negative leading indicator. And it has pretty perfectly shown that recessions will occur in the future. Now, when the 10-2 spread, as they call it, right, the difference between the 10-year treasury yield and the 2-year treasury yield, when it went negative most recently, meaning that the yield curve inverted, the reasoning was unclear, right? And it was pre-coronavirus pandemic. It was pre actually seeing the reason for this most recent recession occurring, which is very interesting because it was a leading indicator to a recession that you could not have predicted. So maybe a little luck there as well. But that is a leading indicator along with some of those other ones that you can look up as well. Now, these are critically important to investors and business decision makers because they can give advance warning of a recession. Second are officially published data series from various government agencies that represent key sectors of the economy, such as housing starts, capital goods new orders, data published by the U.S. Census. And changes in these data may slightly lead or move simultaneously with the onset of a recession, in part because they are used to calculate the components of GDP. Okay, so obviously those things are in place and can run congruent with the recession actually occurring. And then last are the lagging indicators that can be used to confirm an economy shift into recession after it has begun, such as the rise in unemployment rates, right? You see the rise in unemployment, that typically tells you that, hey, you are in a recessionary period, but you don't know that the unemployment rate has gotten to a certain height, has gotten to a certain level until it has already occurred. Therefore, you call it a lagging indicator because it lags the beginning of the recession itself. Then it's important to question what actually causes a recession to occur. Now, numerous economic theories attempt to explain why and how the economy might fall off its long-term growth trend and into a temporary recession. These theories are far and wide and in many different forms. They can be more psychological factors, financial factors, economic factors, all these different types of things. But they try to piece together all of these reasons that a recession may occur. Now, some economists believe that real changes and structural shifts in industries best explain when and how economic recessions occur. For example, a sudden sustained spike in oil prices due to a geopolitical crisis might simultaneously raise costs across many industries, or a revolutionary new technology might rapidly make the entire industries obsolete, in either case triggering a widespread recession. Okay, so this could absolutely occur. If the price of oil were to rise extremely quickly, companies would have to compensate by charging consumers more because their costs are higher, and then somebody may come along and say, well, hey, we can do the electric car better. We can do some type of transportation that is more energy efficient in a better way, and it can disrupt the whole economy and in the short term bring it to a recessionary phase. And so that could happen. Then also the spread of the COVID-19 epidemic and the resulting public health lockdowns in the economy in 2020. These are an example of an economic shock that can take a recession and cause it to occur because something came along and was a disruptor to the business cycle. And it may also be the case that other underlying economic trends are at work leading towards a recession, which may suggest that something like the inversion of the yield curve, like I was talking about a moment ago, which can be a leading indicator, occurred before the COVID-19 recession, but then the COVID-19 pandemic hits, and then you see that things go bad very, very quickly, okay? So things like that can occur. Those types of exogenous shocks can occur. Some theories explain recessions as dependent on financial factors. These usually focus on either the overexpansion of credit and financial risk during the good economic times preceding the recession, or the contraction of money and credit at the onset of recessions. And so this is a big explanation for the financial crisis of 2007 through 2009. There was way too much debt being thrown around way too easily. There was tons of leverage. There was a ton of over expansion, overreaching for whether it be return or whatever it may be for different companies. Companies were over levered. All these different types of things. These financial risks were in place, and these financial risks came to bear and it caused a recession, and a pretty bad one, right? These financial factors can have a huge impact on recessions because they are tangible, they are real. If they are actually occurring, then it can be hard to deal with these things, and it takes some time and it takes some real work by those who are in leadership positions in our country. Now, certain psychology-based theories of recessions tend to look at the excessive exuberance of the boom time before, or the deep pessimism of recessionary environment as explained by why recessions can occur and even persist. This kind of brings us into Keynesian economics, which I'm not going to go too deep into, but it does fall squarely into this category, and it points out that once a recession begins, for whatever reason, the gloomy animal spirits of investors can become self-fulfilling prophecies and curtail the economy downward. Okay, so these types of theories can persist, and the ideas of bubbles and overextension by investors and these behavioral-based things that are occurring. And it's undoubtable that behavior does tend to cause recessions. Our misbehavior within our economy can cause recessions. But a lot of times what ends up happening is that recessions need to occur to bring the economy back down to earth, to bring it back down to some state of normalcy. Some problems that we may have, though, are the fact that there are recessions that occur from nothing really happening systemically at all that's wrong, such as the COVID-19 recession. And then you see recessions that occur like the financial crisis, which were really dependent on the system, and there were issues within the system that needed to be fixed. The problem is that a lot of those issues don't get completely fixed. They get Band-Aids put on them, and then you look up and you can see another recession of a similar type coming. We rarely learn from our history. We rarely learn from things that have occurred in the past, and so it's very interesting to see how our country and how our authorities go about trying to work their way through a recession and trying to put the right things in place. Sometimes I think they do pretty good jobs, but at others it seems like you're putting a Band-Aid on a really deep cut that needs stitches, and we are just not willing to give the stitches that are needed. And then I want to talk to you guys real quick about recessions and depressions, because I know that the Great Depression is something that has loomed as a buzzword in this country for a long time, since it occurred back in the 20s and 30s. But recessions do differ from depressions. Even though a recession was occurring during the Great Depression, recessions and depressions differ. Economists say there have been 33 recessions in the United States since 1854. So if you want to know how common recessions are, just do that little bit of math, right? In the last about 170 years, 165, 170 years, we're talking 33 recessions, right? So quite common that we do have recessions. Since 1980, there have been 4 such periods of negative economic growth that were considered recessions. Well-known examples of recessions include the global recession that followed the 2008 financial crisis and the Great Depression of the 1930s. But a depression is a deep and long-lasting recession, right? Recessions are one thing, but a deep and long-lasting recession is a depression. There are no specific criteria. So like with the recession, the specific criteria may be 2 negative quarters of GDP growth, but there's no specific criteria that exists to declare a depression. Unique features of the Great Depression included a GDP decline in excess of 10% and an unemployment rate that briefly touched 25%. Simply put, a depression is a severe decline that lasts for many years. And so a depression could occur. A depression may be something that occurs in the future. Now, there were a lot of things that were going on in the Great Depression that we did not have things at our disposal as a country that we could step in and fix systems very quickly and try to bring them back to some state of normalcy. And we have these things at our disposal now, which is very helpful. But what happens when we run out of bullets? What happens when the federal government does not have as much room or as much money or ability or interest rate spread at their disposal to help us as much as possible in the midst of a huge recession? You never know what could occur, but one thing is for sure is that recessions can occur in a capitalist economy. They do. They are a part of what occurs, and even though they've been really bad in the recent past, I'm not saying there's any reason to believe that they will get better or easier. I'm just saying it does not mean that they are not a normal part of what goes on in our lives as members of a capitalist society. Now, real quick, I do want to give you a quick history of the different recessions that have occurred in the last 100 years, right? So you really know the Great Depression, the financial crisis, the COVID-19 recession, which we have been in the midst of. But let's really look at all the ones that have occurred. So obviously there was the Great Depression. We talked about that a moment ago. There were really two downturns to this. The first was from August 1929 to March 1933, with a record 12.9% contraction in 1932. The second downturn went from 1937 to 1938, and the unemployment rate reached 24.9%. And that was a pretty, horribly severe period for our country economically, but luckily we dug out and we moved forward. The next recession was in 1945. This recession lasted 8 months from February to October. GDP continued falling until it reached negative 11.6% in 1946. This was a natural result of the demobilization of World War II. Okay, so a lot of things came to a halt because of a world war, which is, understandable. Then, 1949, an 11-month recession, and I'm not going to get into what happened in all of these, but it was an 11-month recession with a peak unemployment of 7.9%. 1953, 10-month recession, resulted from tightening monetary policy. Unemployment didn't reach its peak of 6.1% until September of 1954, 4 months after the recession had ended. GDP contracted 2.2% in the third quarter of 1953 and 5.9% in Q4. And then in 1954, it contracted 1.9% in Q1. So you saw that recession. Then 1957, recession took place from August of 57 to April of 58. GDP fell 4.1% in Q4 57. 1960, the recession lasted 10 months. GDP was negative 2.1% in Q2 of 1960 and rose 2% in Q3, but was negative 5% in Q4. 1970, right? So there was a 10-year period there with no recession. 1970, the recession was relatively mild, lasting 11 months. Unemployment peaked at 6.1%. Then from 1973 to 1975, there was a 16-month recession. And this was having a lot to do with the PEC oil embargo and oil prices and all of these things of the like. This was a result of stagflation. GDP growth was negative for those 6 quarters in a row. Then 1980 to 1982, the economy suffered a double whammy of 2 recessions in this period. There was one during the first 6 months of 1980. The second lasted 16 months. Then 1990 to 1991, the recession ran for 9 months from July 1990 to March 91, caused by the 1989 savings and loan crisis, higher interest rates, and Iraq's invasion of Kuwait. Then 2001, this recession lasted 8 months from March to November. It was caused by the boom and subsequent bust in dot-com businesses. The boom was partially created by the Y2K scare in 2000 and coming out of that. And then obviously we had 2008, 2009. This was the Great Recession, and then the 2020 recession caused by the coronavirus pandemic, both of which we have talked a bit about in today's episode. So what's the bottom line? The bottom line is recessions do occur. It's important to remember that even when they do occur, that does not mean it's the end of the world, even though it may feel like it, even though the headlines may look like it is the end of the world. It is not. Our country has been very resilient when it comes to recessions over time, and we have bounced back time and time and time again. But these are a real part of our business cycle. They do occur, but the expansions far outweigh what the recessions have done to our economy. Our economy has continued to grow at a pretty good clip over the long term. And it's just important to remember. It's important to remember that recessions do occur, and it's important to have a good view and a good definition of what a recession is, and understanding that the country going into a recession is far more nuanced than you may think it is when you think things have gone bad for a short period of time. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video, leave me feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, and be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to keep you accountable to a financial plan and help you to build one that works best for you, then I can do that. Just go to my website, www.MNOwithDylan.com. Click on the Work with Dylan tab, and you can choose the financial coaching session type that would work best for you, and we can begin pushing towards your long-term financial goals together. So tune in tomorrow as I talk about interest rates, and specifically interest rates when it comes to you borrowing money and how they may impact your life and what they actually mean when you are signing up for different types of debt, which I hope you can cease to do in the immediate future. So thanks for tuning in to today's episode of Money's No Object. I'm your host, Dylan Howell. God bless.